And the markets, what they like, Chip, is they like certainty, and we do not have that right now. And therefore, there is a high probability we could make another leg lower.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, two items we've been talking about all month. I want to hit them one more time because it's last call for The Psychology of Retirement. This is a movie you have signed on as an executive producer. We're showing it Monday, April 21st, 6:30 p.m. at the Edgewood Cinema in Lincoln. In case anyone hasn't heard about this yet, David, give us a quick rundown.
Yeah, it's just a great documentary of what it's like to retire in America today, and basically interviews about 6 different sets of baby boomers that are, mostly not prepared for retirement, because nobody thinks about all the things that need to be prepared. In fact, we had a client in this week just talking about when we showed them all the things we cover in our smart planning process, they had no idea they even had to make decisions on certain things. So again, it's really eye-opening. This is not a sales pitch. This is just a great informational movie, and that's why we got behind it. So yeah, I'd encourage you, if you haven't seen it, to get out and see it.
Well, keep listening during the breaks. We'll give you the details on how to sign up for that. And no charge, no obligation, but you do need to register. You also need to register if you want to join us next weekend for Exit and Tax Planning for Entrepreneurs. Actually, David, our in-house CPA, Evan Marshall, is going to join us in segment 2 of today's show to speak more in depth about the class.
Do we name that Exit since it's Easter weekend, or what?
Boom. Rim shot there in production when we send this out. How would you summarize this one for listeners?
This is a really important class for entrepreneurs to attend. I've been, we joke about it all the time, but serial entrepreneurs, I call myself. I've started over 40 businesses in my life, and not all of them successful, certainly, but there are so many missteps entrepreneurs make along the way because they don't get proactive planning advice on how the tax code actually can incentivize the growth of your business. There are so many different things available, and there's ways to limit or reduce the tax liabilities that a business owner would have to pay on many fronts, state, federal, payroll tax, and others that they're usually not aware of. And in fact, about 4 out of 10 businesses that we engage with are in the wrong entity to begin with. They're set up completely wrong and have no idea. And so this class covers a lot of ground on that, and we'll talk a little bit more about this coming up in the second segment.
Well, and again, listen during the breaks. We'll give you the information to how to sign up for the class. Saturday, April 26th, 8 a.m. We'll provide a little breakfast for you if you need it. Saturday, 8 a.m., April 26th. It's right here at the Midwest Learning Center at Retire Smart. We'd love to see you. Be sure to register if you're going to join us. All right, David. Well, we're going to have to contact the White House and get the president on board. He can't be making major announcements on Wednesday afternoon after we've recorded our show for that week. But that's exactly what happened. He said, well, all these tariffs, actually, if you're willing to do a deal with us, never mind, we'll back off. China, on the other hand, we're going to keep clubbing you over the head. But David, you sent the team a notice about how the S&P then had its third best day since 1950. But then just this morning, before we sat down to do this show, you sent the team a chart from J.P. Morgan saying the S&P could fall to 4,000. What is happening in the markets, David, and how do you see this playing? Why don't you remind people what President Trump did last week on tariffs, and then tell us where we go from here.
Yeah. So we said be cautious going into the announcement. We knew there'd be an announcement, but we didn't know what it would be, and so basically you've had all kinds of rhetoric with the announcement that they were laying out all these tariffs, and the markets got clobbered. Well, then, go a week later and they announce, hey, just kidding, at least for the next 90 days, and we're not going to tariff everybody. And woo, the market shot up, and boy, did it shoot. I mean, the Dow was up over 2,400 points. The S&P had the third best day since 1950, right? And I'm a data geek early in the mornings going through this, so I went back and looked at every day for almost the last 75 years, and the only other 2 days that were bigger, there was an 11% up day and a 12% up day. We went up 9.5% on that day last week, right? Those other 2 days, guess when they came, Chip? October of 2008.
Oh, great recession.
So gigantic up days do not come during upswings or uptrends in the market. They come in bear markets. In other words,
bounce back.
So these are what we call bear market rallies, and it's usually not an all clear sign, and usually actually it's a warning sign. If you hadn't already taken notice, you might have an opportunity to de-risk or de-lever your portfolio in a way that has less risk. And of course, we saw the markets fade from that high. And we think they're going to continue to fade here in the near term for sure. And then we saw this article from today of JP Morgan saying, hey, worst case scenario, you can see the SP go all the way down to 4,000. It'll give you an understanding of where we are today. That's another 25% down. We've already lost about 20%. So that would be pretty brutal.
That'd be a shockwave.
Yeah. And it's possible. It's in the cards. In fact, we have it shown on the charts. It's possible. Go all the way back to 3,300, believe it or not. But don't necessarily think that's what's going to happen. But again, the point of this is, are you prepared either way? If you've worked your entire working career, 30, 40, 50 years to accumulate this nest egg, are you just going to take it and sit there and hang in there? You know, that's the advice that your broker may be giving you. Just hold on. It's a long-term game. Or do you have somebody proactively de-risking your portfolio the closer you get to retirement so that this drawdown would not affect you entirely? In other words, our retirees are not susceptible to 25, 30% drawdowns, simply the way we allocate their portfolio. So understanding how to risk manage your portfolio when you're taking income, you really need to make sure you're not fully involved in risk.
So there are strategies to address whatever scenarios present themselves, but you got to be ready to pivot. You got to be ready to make a move, make a change.
Absolutely. And on top of that, this presents amazing opportunity. So for dollars that we want to be aggressive with, now that's a bucket of money. Most clients, if they're not going to spend the money, Chip, for 5 to 7 years out, we could be a little bit more aggressive than the money we would need, this year, the next couple of years, et cetera. So you have to understand how to segment your dollars into when you would access them. But there's going to be an amazing buying opportunity at this market bottom whenever it becomes, especially if you have dollars in tax-free accounts like Roth IRAs. Because if you go in there and purchase something and as it rebounds and if you hit the proverbial home run with it, it's tax-free if you follow all the rules. So again, there's so much to this. But most people are set in their ways. Somebody from a national firm put them in a bunch of mutual funds and just told them to hang on. And that is not proactive financial planning. That's not proactive tax planning. And that's certainly not holistic financial planning in my mind.
David, consumer sentiment seems to be tracking the same way your research is, the same way that JP Morgan is warning. This is not an all clear. We may not have hit bottom yet. Several times during the year, we cite this study from the University of Michigan on consumer sentiment. You shared with the team a chart, and there's also a headline from CNBC. Consumer sentiment tumbles in April as inflation fears spike. University of Michigan survey shows. A lot of people are seeing things in a similar way, it seems like.
Yeah, and so those that are watching on YouTube, you can see the graph here. I mean, we're not talking about tumbled. It fell off a cliff, right? And consumer sentiment dropped aggressively, and the biggest drop we've ever seen really in one measurement, 1 month to the next. And this is a widely followed survey, the consumer sentiment from the University of Michigan. It's been around for a long time. It's pretty accurate. And that's because people are nervous. There's uncertainty, right? If there's uncertainty in your personal economy, you're most likely going to rein in the extra spending. Maybe you won't go out as dinner as much. You might just tighten the reins a little bit. Even if you're comfortable and have employment, you're just not sure. And that's what we're seeing. But imagine that across hundreds of millions of lives, just everybody's spending a little bit less. If everybody just pulls $50 of discretionary spending off the table each month, what does that do to the stocks, to the earnings of those companies where you would have spent that money? And we're already seeing this in the airline industry in particular. And so United Airlines just pulled their guidance for the year. Delta Airlines have bad news, right? Because people are cutting on vacations. They're trimming because they're nervous, and rightly so. And the markets, what they like, Chip, is they like certainty, and we do not have that right now. And therefore, there is a high probability we could make another leg lower. Again, we don't make any of those crazy predictions here, but we're just telling you we are aware of the possibilities, and so we're acting appropriately. And again, this is where you need a proactive team on your side.
Well, your team better be proactive because the hits just keep on coming, David. Here's another CNBC headline. Unemployment fears hit worst levels since COVID as tariffs fuel inflation outlook. Fed survey shows. This was the New York Federal Reserve did this survey. Does it look accurate to you?
Well, we've not seen massive layoffs. I think this next month we're going to see a pretty big jump, though, in the job losses. Doge is starting to take hold. Those numbers will come out later in the year. I do believe you're going to see unemployment start to spike, but I don't necessarily think you're going to get massive inflation for many reasons. For instance, Chip, if you bought, let's just say you bought a pair of sneakers that cost $100, Nike or somebody else that makes them off our shores, right? Well, what is the cost for that product. They manufacture that product for probably around $10, right? That's what it costs to make it. They ship the product here. Then it goes through the supply chain of being shipped out, marked up to the distributor, to the retailer, to the end store who sells it to you, and they make a commission. So the tariff is not on the $100. This is really important for you to understand. What is the tariff on? What do we import it at? At $10.
At $10.
So if there was a 25% tariff, that's $2.50 on that pair of sneakers. Is that really going to change the end price? Some, but is it really going to change that end price?
But more of a negligible. When you hear 30% tariff, right, that doesn't mean it's going to be 30% more.
30%, 25% tariffs across the board would raise inflation 1.8%.
Okay.
And so
that's
people
why,
understand.
the hit
but we are seeing deflationary numbers show up in our economy. Look at gas. Actually, I filled up this morning, Chip, for under $2.50.
Wow.
And so gas has gone down significantly, right? And that's one of the key drivers of our economic growth. So, we'll see what it looks like. I do believe inflation will start to show back up. But again, you got to look at all these factors into what you're doing to predict the economy.
Up next, at Retire Smart, we have a division called Tax Smart that is putting on a workshop for entrepreneurs. Here from Tax Smart to tell us about it is CPA Evan Marshall. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Are you an entrepreneur in need of tax and exit planning? We have a workshop you may want to attend. One of the presenters is with us today. David, please welcome CPA Evan Marshall.
Hey, yeah, thank you, Chip. In the studio via Zoom because he's headed back from Bakersfield, California here tomorrow. Driving back to see us is our CPA, in-house tax authority and chief tax planner. However, he's been chief tax preparer here the last 6 or 8 weeks, going nonstop. But none other than Evan Marshall. Evan, thanks for joining me.
Thanks for having me. Yeah, April 16th is a good morning to wake up on when as a tax preparer. That's for sure.
Yeah, CPAs are toasting glasses all over. The mimosas are probably happening in offices. Who knows what's happening this morning?
A lot of hungover accountants this morning. That's for sure.
Yeah, my brother, my younger brother was a CPA practicing in public accounting for many years back, and I remember the relief he got on April 16th every year. So a lot of people are done, but there's a lot of tax people that work in tax this morning that are not necessarily feeling that relief. Can you talk about 20,000 of those folks in general?
Absolutely, yeah. So what you're referring to are our friends over at the IRS. So earlier this week, there were some reports that came out that they're expecting a huge portion of the workforce to be cut, with some more developments likely happening by the end of this week. We've seen estimates from anywhere from 25% up to 40% of the workforce could be slashed. And that's through a combination of buyouts offered by the Trump administration and also just general widespread layoffs. And that it could be a huge impact on the processing and audit procedures from the IRS.
Well, and a lot of people are unfortunately taking this as we don't have to file. Even one of my adult children's like, well, I don't have to file. No one's going to. Yes, you do, son. and not only that is, look, automation, AI capabilities, the advance of fintech in general is going to allow the IRS to do more and collect actually more revenue from the studies I've seen with about half the workforce, but it's going to take some time to work through that. And yeah, they're going to target between 20 and 40%, as you said, and then we're going to lose about 6% a year through attrition. And so over the next 5 years, that'd be another 25%, and they would be down to their target of about 50% of the staff they currently have. And look, again, we work with a lot of government employees, a lot of federal employees, retired and active workers. We're not saying anything bad against the workers, but the archaic systems that our government employees, software systems and things on all divisions is so archaic. They are so unproductive relative to the private sector. It's insane. So I think this is a welcome change, and the American people, I think, did overwhelmingly vote for this type of thing. But it doesn't mean you can't pay your taxes, folks. You need to have paid your taxes. And again, some folks like myself always file an extension. That doesn't mean my tax bill wasn't due. Can you talk about that for a minute, Evan?
Yeah. So, commonly with entrepreneurs or those with maybe more complex tax returns, we often do see those tax returns being extended from that April 15th deadline to that 6-month extension to October 15th, excuse me. But yeah, like you're saying, David, that tax bill is still due on April 15th, whether or not an extension is made. That extension just gives you 6 more months to file the return, but not necessarily pay the tax. That tax bill is still due come April 15th.
Absolutely. So, speaking of the tax bill that just was due, a lot of people have been benefiting for the last 7 years to what's most people call the Trump tax cuts. It's officially the Tax and Job Act of 2017. But it's an amazing that 91% Americans, according to the article you sent me, 91% don't really know a whole lot about this. Only, less than 1 out of 10 people, and about half of them have no idea it's expiring this year.
Yeah, I thought that was really interesting given, how the education process that we share with our clients, like the current tax environment that we have right now, the current rates, the current standard deductions that a lot of our clients get to take advantage of, that's set to expire under current law at the end of this calendar year. So the article that I shared was a survey from the Cato Institute that said that 55% of respondents had no idea that the current Tax Cut and Jobs Act is actually temporary and set to expire at the end of 2025. So a lot of our clients have that understanding. We're trying to take advantage of the current tax environment as we have it. We're optimistic that these tax cuts will be extended either temporarily or permanently. But from a planning perspective, we're still living in the current tax environment and the current law, which does show that the current tax rates are set to expire at the end of this year.
Yeah, and obviously that we do have a high probability that will change, but again, we just want people need to know what the law is and then be prepared because when it comes to proactive tax planning for retirees, which we do every day, and even entrepreneurs, there is a lot to build into a proactive plan, and then you've got to have some flexibility if, hey, Congress didn't extend it, or they fight and they don't extend it completely. And there's even talk now, the Republican side of the aisle trying to appease people. We do know from their Commerce Secretary, Howard Lutnick, that they're trying to increase the amount of people on the bottom end that don't have to pay any money into the tax. They're on record saying basically a joint family earning $150,000, they would like to have a zero federal income tax liability. Now, whether or not we achieve that through tariff revenue or something, I don't know yet. But I know that they're also trying to appease people by taxing the so-called rich and adding an eighth tax bracket above $1 million in income, which would, again, not affect a lot of people. So it's easy for them to sell it. But it still goes with that mantra, hey, we should tax those people that are, doing well, et cetera, better. But again, if you're out there earning that kind of income, you probably are like me. You have a team of strategists helping you practically understand how the tax code works. And again, you're not cheating the tax code, folks. There's 1,700 incentives built into our tax code through the 50 states and the federal tax code to lessen one's tax burden because they're incentivizing you to do something that benefits society. Start a business. That's why you can write off expenses because you're probably going to hire people. That's good. Employment is good for the society. Can you just talk about why tax incentives are built into the tax code? They're not cheats. They're there to provide an economic benefit.
Yeah, it's really using that language when we speak to our clients of the incentives. So like for an example, one of those incentives is home ownership. Want to incentivize Americans to own their own home. It's good for the economy. So for example, like mortgage interest and personal or property taxes on the home, those are deductible expenses as itemized deductions. But for example, right now in my circumstance, like my rent expense currently is not tax deductible. Right, wrong, or different. Those are just some of the incentives currently in the tax code. And the biggest one that we work with is charity. The government loves their citizens to be charitable. So charitable contributions are deductible as an itemized deduction. We work with a lot of our clients who do qualified charitable distributions to kind of work around their required minimum distribution and help their tax liability that way. So those are just a few of the examples kind of written in the tax code that we see most commonly with our more day in, day out clients or those with, the more simplistic tax returns.
Well, absolutely. And that really helps a lot of retirees how to lower their tax bill throughout retirement using some of those strategies you just mentioned. Let's pivot for a moment, though, and talk about the ones that you kind of focus on for the rest of the year because tax season over for the average American. But business owners, if you're like me, April 15th is a very painful day. I had to send another 6-figure distribution to the IRS, and this is just a quarterly payment. Now, certainly I am blessed financially, I've done well, but these are very painful payments to make. And of course, so I want to do everything in my power legally to reduce those required payments I have to make. So we've developed a class because you and I have been working together for multiple years now. Before you were an employee of ours, you helped me with my own personal tax return. Of course, I gave you a lot of the strategies so you could filter those out to some other clients at your old firm. But let's talk about the class we're doing. So we have a proactive tax planning and exit planning class coming up here at the end of the month for entrepreneurs. And this class is really targeted on entrepreneurs who are probably like me, just holy cow, I had to write this big old check. Could I have done better? And the answer is almost always yes. You probably could have done better, but you have to get proactive. You can't do anything after the fact. We can't change last year's tax return, but we can certainly make hay and give you strategies and things that will be applicable in 2025. Can you talk about what we're going to cover in that class coming up, and when is the class, Evan?
Absolutely. Yeah. So this will be a great class for those entrepreneurs, especially those who are day in and day out, facing those, high tax burdens like David was mentioning. So some of the main things that we'll discuss are really some common tax challenges faced by business owners and entrepreneurs, what the benefits are of working with a proactive financial and tax planning team. And we'll do kind of an introduction of some of the strategies that we implement with our entrepreneurs and the considerations that we use. And this is primarily going to be focused through the lens of tax and exit planning. So, tax planning on a proactive basis is great, but we want to take a step further and do it through the lens of, okay, what does exiting your business look like? What does harvesting some of the value you created in that business look like? Because for most of our entrepreneurs that we see, an overwhelming majority of their net worth is tied up in their business, and they don't really have a lot of sound strategies of what they're going to do to really collect on that value that they've spent so many years creating and what that next step looks like. So if that class sounds like something that you or a good friend would be interested in, that will be hosted on Saturday, April 26th at 8 a.m. at the Midwest Learning Center.
And we are going to provide breakfast, but you must register for that class. So you can call 402-369-7777 to get registered for that. And I will tell you, the exit planning portion is really critical for business owners, even if you're not planning on exiting, because you may be forced to exit. There may be circumstances that come upon you, a health issue, divorce, disability, all kinds of things that could force you to liquidate or sell your business. And we want to be proactively planning, even if you just want to transition to the next generation. Do you understand what the taxation looks like on that? Gift tax, inheritance tax, all those things are covered and so much more. Evan, we are out of time for this segment. We look forward to the class. I'll be teaching it with you alongside with Mike Schutel, one of the advisors on our team. All three of us have earned what's called a CEPA designation, which is Certified Exit Planning Advisor. And I think it's really neat because we come from the entrepreneur, the financial advisor, and the CPA angles, three different angles of the same information. I think it's going to be really beneficial for those entrepreneurs. So we'll look forward to seeing you back here in Omaha next week, brother.
Absolutely. See you soon.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about the do-it-yourselfer phenomenon. Here's the question. My husband is constantly buying and selling stocks and mutual funds without any advice or guidance. Watching him constantly move our money around is giving me heartburn, especially in the current economic and financial environment. Surely you run into do-it-yourselfers in your business. How do you convince them to let you help them?
Well, to be honest, we usually talk to you, the spouse that's not the one doing it.
Well, I've joked numerous times you're a quasi-marriage counselor in this
yes.
job. Yeah.
So listen, there's a lot of folks out there that like to do this stuff. It's fun to them. It's almost like a hobby, or they take pride in it. The question I would have is, do they have a process? I've met very successful do-it-yourselfers, and I've met some that just had pure luck on their side. They picked a couple of things and they went well, but they didn't know when to sell. So do you have a process? If you're a do-it-yourselfer out there, look, do you have a process on how you choose what to buy? Is it rules-based? Do you have some kind of methodology? And more importantly, Chip, I have to ask them, do you have a process for when to sell? And rarely do I ever get that answer back. So this is common when we have spouses.
Because even if you got it right on the front end of the transaction, you could blow it on the back end of the transaction.
Absolutely. And then the other thing is you need to understand is what type of account are you doing all this buying and selling in? So if you're buying and selling mutual funds are extremely expensive to buy short term, very expensive. And you may not even understand all the fees and expenses you're paying because it's taken out of the return of the investment. And again, this is where some folks that don't have quite the education in these instruments and how they really work. So I can understand this point, but I would just tell you, there's nothing wrong with if somebody wants to have the fund money account, if you will, but to do this with your life savings is typically a mistake. We would not tell an attorney to represent himself. We would not recommend a surgeon operate on himself, right? You need to get counsel and advice. Even me, when I invest my own dollars, I go get other people's counsel and advice because there's no emotion involved for them with my money. Just like I don't have any emotion involved or tied to our clients' money. So it's a great point, but typically, if the spouse were to ask, listen, can you let a professional handle at least half of our assets? That may be a conversation you should have with your spouse. We're here if you want, but you should talk to somebody.
Next question, David, is about the timing of an IRA withdrawal. We want to buy a house in the country. We don't have much cash in the bank, so we'd probably have to take money out of our IRA for a down payment. I'm 64, so I wouldn't have to pay a penalty, but I'd still have to pay taxes on the money. Is this a bad idea?
Well, the housing market is certainly not a great situation right now. Mortgage interest rates just went back above 7%, and inventory is starting to come to the market. So I think there's going to be some pressure on sellers to reduce prices. So there may be an opportunity in the near future. And again, if it's your dream retirement home, et cetera, we can talk about what those cases. But to take money that you're going to have to pay federal and state tax on, even without a penalty, you still owe income tax.
So this must be a traditional IRA, right?
I'm assuming so, yes.
No taxes paid on the front end, but you pay when you take it out.
It says IRA, not Roth IRA, so we're going to assume it is in a tax-deferred account. So when you bring that out, you're going to pay federal tax. And let's just say the average dual income family, I believe it's a couple here, if they were going to pull this out, most dual income couples are in the 22% tax bracket. And then here in the state of Nebraska, assuming you are in the state of Nebraska, that's another 5.64%. So now you're having to pay almost 28% tax on that. So if you took $100,000 out, you're going to give 28,000 of that up to the tax man. You're only going to have basically 72,000 left as your down payment. So I would take as where if you could borrow that money, maybe on your current home, if you have equity, you could take out what's called a HELOC, a home equity line of credit, and borrow money tax-free just for the short term to give the down payment to help you acquire the mortgage on this house, assuming then you would sell the house that you have. Again, I'm making a lot of assumptions here. Then you would take the cash out, that equity, and then pay that loan back off when you sold it. Therefore, now you only have one mortgage and you never had to tap your retirement account early.
Wow. Use the existing house to get the new house.
Yeah. And because they mentioned they're 64, taxes. You may, there's also what's called a home equity credit mortgage, which is a reverse mortgage. And again, we don't recommend these all the time, but they are very useful tools to help you actually acquire another house if you've got equity in your current house. So again, a lot of factors go into this, but you don't know what you don't know. We say it all the time. Great person to set up one of those 15-minute discovery phone calls with one of the advisors on the team.
Here's a 401k question, David. My employer just sent out a letter saying the company no longer will match my 401k contributions. Should I stop contributing and put the money elsewhere or leave it as is?
So unfortunately, this happens when the markets go down. The reason we'd like folks to put money in a 401k is twofold, though. One, you typically do get a match, so there's free money available to you. Hopefully your 401k is over 93% of them do offer the Roth side of it, so you can put money in there. The advantage of the 401k is you can put more money in that than you can a Roth IRA. So you could put $27,000 in there in your Roth 401k or 23, et cetera, whatever the number is, depending on if you're over 50 or under 50. You could put more away than you could put just in an individual account, and you could be deferring that, never pay tax on that money again. Even if the company is not contributing, that may be a smart move. Again, I don't know your whole circumstance, but you should definitely contribute to a Roth IRA and fill that up. And if you're going to contribute more than what you can put in the Roth IRA each year, then the 401k would make sense. And again, we would love to talk to your employer of help them to understand why that benefit was there in the first place. It's to attract and retain good talent taking away that match was probably a fiscal mistake from the company, and they probably should come to our tax planning class we just talked about with Evan there, and understand how to take advantage of the tax code, because there are incentives, there are tax incentives by giving your employees a match, by the way, if you didn't know that as an employer.
Well played, Mr. Brooks. This strikes me. So many of our questions, it boils down to there's not a one-size-fits-all answer for these questions. That's why, if not us, find somebody to visit with and bounce these scenarios off of to help you clarify what the best option is for you.
And that's why we talk about with the SMART plan is 5 key areas. But every decision you make in one area has both intended consequences. You're doing something for a reason, but it has unintended consequences that ripple over into the other areas. And if you don't put all that together, you could do more damage than good, even though you think you're making a great decision. And we see this all the time. I just met with a couple that came in. They've been listening on the radio for a while. They finally decided to come into one of our, take advantage of one of our complimentary consultations. So I happened to just get introduced to them. And he's like, I've been listening to you for the last couple of years. So I did a Roth conversion last year. Well, the number this person did blew their tax bill up significantly and created penalties on what's called IRMA, Medicare.
Oh my goodness.
Again, don't just, that sounds like a great idea, and swing the bat. You need to know how much you should be converting to the penny. Why are you converting them out? What are the consequences? And then what are the repercussions from that decision later on? Are you going to affect your Medicare premiums? Are you going to affect your Social Security taxation? All these other things, you've got to have somebody help you put it all together. We call it a SMART plan.
Well, speaking of finding the right kind of help, up next, there is a difference between a financial broker and a financial advisor, and it can make a big difference for you, the consumer of financial advice. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, you alerted the team to this, and I have to admit, when I first heard about this, I thought, well, that sounds like an inside baseball discussion in the financial industry, just fussy debate about semantics. But you've convinced me that it's not. Okay, here's the headline from the Financial Advisor website. Should brokers be able to call themselves advisors? NASAA says no. That stands for North American Securities Administrators Association. You came into the financial world as a broker. You are now an advisor, and you believe there's an important difference between the two and that it matters very much for the consumer. What's the difference, and why does it matter?
Yeah, so when I started in this industry, we were what we would call dually licensed. We were brokers and we were advisors. I was licensed as both. So a broker is someone who brokerages a transaction and gets paid for the transaction. And they could get paid from you, the consumer, via a commission, or they could get paid via what's called a markup within the product that you buy. And so it's another form of a commission. They just don't call it a commission. This is done in the bond market very often. If you go buy bonds, when I started my career, I worked for a company called Payne Weber. A lot of municipal bonds. You got to remember, interest rates were back at 10% when I started many, many years ago. Tax-free interest at 8, 9, 10% municipalities. Orlando Utilities Commission, I remember that greatly. And that would be how I'd start a relationship. Hey, Chip, 10,000, you buy 10 of these bonds. Let's say the bonds were priced, and bonds typically are priced at $1,000 each, but they trade based on interest rate fluctuations, right? So interest rates go up, the prices go down, and vice versa. So let's say interest rates moved up since the bond was issued. It's on the secondary market, and it's trading for we have it in our inventory at $962 for the bond. We can mark that up if we're a broker wherever we want. So I can sell you, the consumer, the bond for $982, right? And if it was a 5% yield on that bond, just using a round number, at $1,000, at $982, your yield is higher than that, right? So I'm like, hey, you're getting 5.17 or whatever the number is, but I marked it up $20. If you buy 10 of them, that's $200 in markup. And that's how I made my living. I was a broker doing transactional business. And just so you know, at most broker dealers, they earn about a third of what they generate in revenue for the firm. So my cut or commission, if you will, would have been, in that example, if I generated $200, about $65 or so, right? So that's what I would have earned on that phone call, on that sell. And that's how you, smiling dollars, we used to call it. So, and then we got our advisory licenses, but nobody really did much fee-based business back then. It was a little bit. In 2003 is when I shifted significantly my own process to. But I was a broker all the way until 2012 when I let my brokerage licenses go and decided to only act as an advisor. And
let me stop you for a second. You said fee-based. What you mean is we're going to charge you a flat fee up front, and then any transactions we do, we're looking out for your best interest, but we don't charge you by the transaction.
So there's different way advisors can charge, and so any advisor can set up his own way, but the most common way is what's called assets under management. So you're going to charge a fee, 1.5%, somewhere in that neighborhood is the industry norm on the assets that you're managing. So in other words, if the account level grows, the fee gets to grow. So by making good recommendations, instead of getting paid for the transactions, you're getting paid to actually grow the account value. Your interests are now more aligned with the consumer or the client's interest in that example. Now, there are great advisors and brokers and the like, and most of them just call themselves advisors, and they work at many large firms. So what this distinction is you're going to have to figure out which hat are they wearing. So right now you need to ask, right? And they should be disclosing it to you because there is what they are referencing there, a potential conflict of interest. So when they sell a product as a broker, this would be a variable annuity, a non-traded REIT, BDC products. These are very commonly sold in the wirehouses and the regional big box firms out there. When they sell it to you, they're making a commission, unit investment trust, all kinds of these vehicles. And so they sell that to you as a commission, but they might also have a fee-based account over here. So they might have two accounts for you. We see this very common with an organization that has a lot of offices nationwide with typically one broker in each office. You know, they're in rural towns. You can figure out who they are. But very common, the client will have a fee-based account and they also have a brokerage account. Well, that brokerage account, they're earning commission. You just need to understand, again, it's not that it was unethical, but was it disclosed probably? Does the consumer know how the advisor is getting paid? So we only act as an advisor. We do not ever earn commission for any securities or investment product ever. Now, full disclosure, we are also licensed insurance agents. If we need to put a Medicare policy in place for you, if we need to sell you life insurance for your estate plan, or even use something like a fixed annuity, we get paid a commission from the insurance company. But that is disclosed to the consumer, to the client, because that is a potential conflict of interest. In other words, so this is just going to make it easier and clearer if this gets fully enacted. In other words, this is the NASAA's wishes under what's called Regulation Best Interest, Regulation BI. The SEC wants the consumer to know who they're dealing with. So you just need to know what hat. So if you're not sure and you have a good relationship with a financial professional, just ask them whatever recommendation. Hey, what hat are you wearing today? Are you a broker? Are you getting paid from the product? And it's not necessarily a bad thing. Just you need to ask it, right? Or are you getting paid, from me? And
there's a term we often use, and I want to know exactly where it fits into this conversation: fiduciary.
So fiduciary, now, in my mind, in the legal definition might be slightly different. So, but legally, what I believe it means is you are requiring yourself to do what is in the client's best interest, period. Even if it's not in your own best interest or even if it harms the firm, et cetera, you are obligated to do what you think is best for that client. But again, when there's conflicts of interest. So in other words, I have somebody we're working with right now that we're setting up what's called an irrevocable life insurance trust. We are funding a very large life insurance policy inside an irrevocable trust. This is going to be set up to pay estate taxes for a family. It's going to have a big estate tax problem under current law. I'm going to get paid a commission when they purchase this life insurance. That's just, so we disclose that to them. But again, it's just having this communication. But a fiduciary should be doing what's in your best interest. And we believe on the investment side, it's a cleaner, easier way to understand business if I get paid off the account value, because now if I grow your account value, I get rewarded for making good decisions. And it also, in times like this, turbulent times, I am making the necessary moves, or should be proactively trying to reduce the drawdown, because if your account goes down in value, what happens to the fees of the firm?
Well,
they would go down too. So again, if someone just sold you a commission mutual fund, somebody earlier talking about they're buying and selling mutual funds. There's A-share mutual funds that typically have a commission of like 5.75%. Not only do you pay that up front, so if you invested $10,000 in this mutual fund, tomorrow $575 went to pay the commission. You don't have $10,000 in your account. You would have basically $9,425 actually go into the fund. And then every time you dividend reinvestment, a commission is paid again. Just understand what products you own, how they're paid, and how the person you're working with, how they are compensated. Again, if you're comfortable with it and they're comfortable with it, then everything should be fine, but it should be disclosed.
All of our dozen or so licensed financial advisors operate as fiduciaries. Last question from me. Is the term broker and fiduciary mutually exclusive, or can a broker also be acting as a fiduciary?
Well, they are not, when they got the broker hat on, no, they're not acting as fiduciary. They're acting as a broker. Their transaction, it's just like in real estate, and there's been a lot of changes in real estate, right? You have a buyer, sometimes you have buyer representation, seller representation, and most common these days you have, I don't represent anybody. I'm just brokering the transaction and getting paid, so they're not representing you. You follow me? And so brokers are not acting as fiduciaries, but they could be acting as fiduciary when they are an advisor if they're duly licensed.
David, you are, as you describe yourself, a serial entrepreneur. You have started several businesses, and I know bankruptcy, it's a part of capitalism. Not all businesses succeed. But here's a headline from Fox Business. U.S. corporate bankruptcies rise to highest Q1 level, first quarter level, since 2010. Red flag there?
Yeah, that's a precursor to usually telling us there's going to be some drawdowns or whatever in the economy, because if entrepreneurs are closing up shop, then that's less job creation, right? In fact, that's actually job destruction typically. And that's just a sad state of affairs when businesses get over levered, and that's just businesses are simply, they have to have cash flow, they have to have run rate, if you will, they have enough cash flow to operate for downturns, et cetera. And so a lot of businesses don't operate correctly. Again, that's another plug right there for the proactive tax planning and exit planning for business owners, because I have had to counsel multiple entrepreneurs through bankruptcy when the economy's turned down every once in a while. And back in 2007, 2008, 2009, I had several clients that actually had to file bankruptcy. And there's good news there, Chip. The bankruptcy law is there to protect you from the creditors that you owe. And so there are different forms of bankruptcy, business and personal, Chapter 7, Chapter 11, Chapter 13, et cetera. But there are assets that can be protected from those creditors, in particular your retirement accounts. So don't make the mistake of going and taking $200,000 of an IRA to pay off a creditor when they couldn't get to it anyway. In other words, understanding the rules, what state you're in, they're different in each state, but these are the things that proactive planning can help counsel people through so they don't make an unwise decision.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer, including the movie, The Psychology of Retirement, including our Exit and Tax Planning for Entrepreneurs class. There's no charge, there's no obligation for our events, but you do need to register. You can do that online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. Hope you had a wonderful Easter.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.